Hi, this is the online lecture for preparing for our in-class work related to tax research. And it's going to cover two topics, and when we return to class on Tuesday or Thursday, there will be 5 multiple choice questions on the quiz related to these two topics. So the first topic is, how are federal taxes computed for individuals? And the second topic is, what kinds of laws, regulations, or other authoritative matters are out there that govern the computation of federal taxes for individuals? So basically, the online component here is giving you some information about how taxes are computed and the kinds of sources we'll look at when we get to class for doing research. So on page 1 of the outline is a table that shows the formula for computing taxable income and taxes for individuals. And if you're familiar with how the items in the left-hand column work, you should be fine for answering any questions. So it all starts with gross income, and the law in this case is pretty clear. Gross income is basically all of your income for wherever it comes from. So I have listed up there some examples. Wages. If you run your own business, the profit from that. If you own apartment buildings or shopping centers, what are your rents that you collected? Pensions. Even if you engage in crime, right? The money you gain from criminal activities is considered income. So once all the income is known, there is a second section that says some of those amounts can be excluded that you received. So for example, gifts, scholarships. If you were injured and received compensation for that injury, that would be excluded. If you were the beneficiary of a life insurance policy, that would be excluded. So take all gross income, subtract these adjustments to gross income, and we end up with a subtotal called AGI, or adjusted gross income. Once you know AGI, the tax law says that other things can be deducted before we figure out your taxes. And there's 2 ways to go about figuring out these deductions. First of all, the tax law is written that says for a single individual, you can subtract $6,300 from your income before you go and figure taxes. Or you can take a second approach and add up the amounts you paid for various items that are called itemized deductions, and if the sum of those itemized deductions is greater than, in this case, $6,300 for a single individual, you can subtract the greater amount. So some of those things would be if you paid state and local income taxes. A lot of homeowners use the next 2 items. They'll pay property taxes on the home, and they'll pay interest on the mortgage that they for the money they borrowed to buy the home. Fourth example there, and by no means is this list complete, would be money that you gave to charity, right? So a charitable contribution can be listed as an itemized deduction, and that can help lower your taxable income. Once you've subtracted either the standard deduction or itemized deductions, you can then subtract exemptions. And so you could kind of think of this as how many people are in your family. For each person in your family, there's a $4,000 personal exemption. So a single person, $4,000, husband and wife, $8,000, husband, wife, one kid, $12,000, and so forth. So now that you've subtracted the specifically excluded items, you've subtracted itemized deductions, you've subtracted exemptions, you get to a number called taxable income. Congress can change the tax rates at different times, and so the table that you see on the screen is the tax rate for a single individual. So somebody with taxable income up to $9,225, they're going to pay 10% of that amount as federal income tax. When you get to $9,226, that dollar and those up to $37,450 are taxed at 15%. And for those people in the 400,000 plus range, they're paying almost 40% of their income in federal taxes. So that amount equals the gross tax that is due. Congress has kind of adopted a pay-as-you-go approach for taxes, and so the example that most of us are probably familiar with would be for each paycheck that you've received, there's a deduction on there for federal taxes, and what your employer is trying to do is look at how much you made in that pay period. If you continued to earn that amount for the year, what would your federal tax liability be? And then they deduct an amount that would represent a percentage of your federal taxes that are due. For people with a lot of outside income, where their deductions on the paychecks don't cover the amount of tax that's due, they have to make separate payments to the government. So if the payments you made exceed the taxes that you're due, you're going to get a refund. If the payments you made are less than the taxes that are due, you're going to get you're going to have to owe some taxes. So that's the basic formula for computing income taxes. Like I said, be familiar with these steps, and you should be okay. On the next page, and we're correcting this in real-time spelling, a lot of people have tried to get creative with taxes. So we're going back a few years, but Al Capone was a incredibly famous criminal back in his day. He did a lot of business in cash. The tax law says that it's income from whatever source. So the cash he received from crime, he never paid tax on it. That's finally how they convicted him. The second picture you see, that guy's name is Ty Warner. Guy made a ton of money selling a product called Beanie Babies. He evaded tax liability. He had to pay $27 million in back taxes. Willie Nelson is a country western singer who goes back a few years. He owed millions in back taxes. He had no way to pay it, so he went and created an album called the IRS Tapes, and the proceeds, the profits from that album, were solely used for purposes of paying his debt off to the IRS. So when you look at some of these tax rates, right, and how much of a person's income could be lost to or paid to the federal government, I guess we can see why there might be some motivation for trying to either lower your income or increase those deductions. So the next section then deals with, well, what tells us what is income? What tells us what can be deducted? And we probably in class won't have time to look at all of these, but I'm going to provide a few examples, and if you could be familiar with what these are, you should be fine for the quiz. So the Internal Revenue Code are laws that are passed by Congress and signed by the President, and that's what determines what's income, what's a deduction, what's the tax rates, those sorts of things. So since it's a law, if the President disagrees, is not supportive of the law, it can be vetoed. If a law is vetoed, the supermajority of the House must overturn it. So for example, if you went to Internal Revenue Code section 61, that's the part of the code section that states everything is gross income from whatever source derived. The law also states that the Internal Revenue Service has authority to make some rulings that further govern what we pay in taxes. And there's 5 or 6 of those, but we're going to just look at 3 of those. So the one with the highest authority are called regulations, or sometimes it's referred to with an abbreviation called regs. And this is the Treasury Department's official interpretation about how a particular section of the code is to be applied. And they are given great weight by the court, and as it mentions here, unless something is found to be clearly contrary to congressional intent, the regulations tell us what we do. So for example, if code section 61 is telling us what's income, the related revenue section is 1.61, right? The 1 point prefix tells us that it's a regulation. 61 tells us that it's related to income. And if you went into D1, it talks about what do you do if you get paid in property. So, you know, somebody gives you a car, right, or some other tangible item other than cash. Well, that code section says that property, based on its fair market value, must be included as income for compensation. The second item is called a revenue ruling, and in this case, the Internal Revenue Service has looked at a particular factual situation that a taxpayer or group of taxpayers has presented to the IRS. The IRS says, you know, that's something that's going to be of general interest to a lot of people, and so they provide an analysis as to how it would be treated. Then a different situation, which is called a letter ruling, also relates to a particular fact situation, and in that same case they provide a ruling that can be relied upon. At one time, the letter rulings, to just kind of differentiate 2 from 3, were thought of as private. So in the case of number 3, a taxpayer might propose a certain situation to the IRS. The IRS comes back and says this is how we would treat that. Through the Freedom of Information Act, those letter rulings, the IRS was forced to let the public know about those letter rulings, and so now private letter rulings are just made public. So if a taxpayer has a situation that relates to one of these forms of rulings, they can rely on the revenue rulings or the letter rulings to give them some guidance as to what to do. And then the final source of authority for what we might do regarding taxes comes from the court system. So since the taxes law, there's an opportunity for a case to be disputed. And so as you look at this chart, there's 3 paths that a taxpayer can go, or that the IRS can go, in order to make a claim. So starting from the left, in the case of a taxpayer who has not paid tax, the IRS is going to go to a authority called the tax court in order to make its case that taxes are due. The second 2 courts, the district court and the Court of Federal Claims, are available to taxpayers who have paid taxes, but then dispute the amount paid and are suing for a refund. So the U.S. District Court is the general court of claims, and so they can hear many types of cases, one of which is a tax-related matter, and in the case of a district court, a taxpayer would be entitled to a jury trial. The Court of Federal Claims is a special court that hears cases related to monetary claims against the U.S. government. So in that case, it's heard by a judge, no jury trial available there. If the matter is decided and there's still some dispute about the decision, as you see, we can go up the chart to an appeals court. If there's still some indecision about the matter, the item can go up to the U.S. Supreme Court for a decision. So, in summary, the Internal Revenue Code is the primary source of authoritative information about what is income, what can be deducted. That doesn't cover everything. And so in order to understand or to interpret the code, there could be administrative interpretations. Those come in various forms from the IRS. Or there could be judicial interpretations. Those come in the form of various court decisions that interpret the tax law. So I hope by this introduction you can see that the computation of income tax involves many different steps and figuring out many different numbers. And I hope by looking at the second part of the lecture you can see that there are many different sources related to where we can get information. So tax is pretty complicated. I hope this gives you some insight into that. And as I mentioned, we'll have a 5-question quiz on these 2 subjects when we return to class on Tuesday or Thursday. Thank you very much. I'll see you in class.